July 2026, arguably one of the most crazy times for being an investor long term. There's so much news going on, bearish, bullish, AI, capex spending, valuations are crazy, the debt's crazy, everything's crazy. So how do I plan to perform and outperform over the next 5 years and actually perform well? In this video, I'm going to break down tips, processes, what I'm going to be doing to really kind of go full steam ahead over the next 5 years. Whatever happens, I believe I'm going to be fine due to these reasons. So remember, this is my own research, my own opinion. Please do your own work. Please watch this and do research off the back of it. Hopefully this creates ideas in your head and think, I could do this. But if you do want to get a further breakdown into what I'm doing, I do have a free newsletter. Link to that will be in the description. So look, this was really interesting, something I came across on Twitter, I believe, or Google Images or whatever. It's a Warren Buffett valuation indicator. So disclaimer, I'm not a value investor, but it's always good to look at things, even if it's not something you religiously look at and you think you're an expert in, still look at it and still see there's some value in it because other people see value in it. So as you can see here, we've got valuations pretty much at an all-time high, going all the way back to post-World War II. So as you can see, every time we've gone here, there's been a crash. Every time we've gone here, there's been a crash. So yeah, it does seem to work. We just missed it there, but yeah, pretty telling that the market's probably going to pull back and probably not going to continue in the near term. You could argue that, but as you can see, if you were to be very bearish there, 15 years time, 15 years is obviously a long time, you would have made money. Same here around COVID, you would have made more money. So don't just think, this is here, that's that. It's too simple. But it's really good to look at and think, okay, cool, we are in historical valuations, especially in the US stock market, which is where a lot of people put their money. So you're probably going to think, I don't want to go into the US long term. However, if we had the stock, price on, it'd be going like that. But there would be, periods of time where, throughout this period where there'd be better opportunities. There'd be periods of time through here, better opportunities. So there is better opportunities in this, but ultimately it does go there. And as I talk about, when you're looking to invest in multiple asset classes, you're not looking to catch 100% of the volatility. You're looking to catch 80% of the upwards volatility. Because if you average 80% out across a couple assets, which are going up and to the right, you're going to do really well. So while the data alone is not enough, the Buffett indicator has been flashing red for years, and it's gave us multiple signals over that time. And you would have lost money if you if you sold in 2020, 2021 and 2024. The stock market has gone higher then, so technically, yes, it's been flashing red. Maybe it's a signal, bang, goes down. And look, the market can stay in crazy valuations for some time. Japan's a really good example if you want to do some research into that. Typically, a bear case requires a catalyst. So typically you do have, maybe, the new Fed chair, Kevin Walsh, says we're going to, bring rates in, we're going to, cut rates, or, we're going to hike rates, and has more of a hawkish approach to things. Market might ignore it. There might be some signs there, and then bang. If you believe price leads narrative, you believe price creates the catalyst. But ultimately, you do have crazy things which lead up to these things, like AI stocks, you could say, AI capex spending, or OpenAI and Anthropic, they're just spending too much, they're not much making any money, and they're going to go down. And the market, may continue to be bullish for half a decade, like stocks have done, according to the Buffett indicator. So data's not enough. Relying on one thing, unless you understand it really well, unless it's your own thing, it can work, but you've got to be cautious, when you're just looking at one thing and pigeonholing your mind into one thing that it may not work. So look, a process beats prediction. So this is what I talk about all the time. You need to have a process. Nobody, consistently predicts market directions. If you call the bottom or the top, once, doesn't mean you're going to keep calling it, You want to have something which is very repeatable and, very simple. So a process works regardless of which way the market goes. If you have rules for what you're looking at or how you act, you don't need to care about market direction. The charts tell you. I'm a chart-based investor. I think it's the most objective way of doing things. Opinions don't matter. You can just say, does this happen on the chart? Yes or no. If it does, you enter, you sell, whatever. And it moves you away from being married to a bias, because that can be one of the most expensive mistakes. If you are long tech in the US and you think tech's the best thing, tech's the next thing, whatever, you could be married to that bias even when the stock's 20% down. You think this is a great dip to buy, it could go down 30%, great dip to buy, 40%, it can never recover. So you don't want to be married to a bias. So you want your process to be very hands-off, emotionless. It's very hard to be emotionless, yes, but you want to maximize that where you can. And you want it to be very simple that you can explain it to a 5-year-old. Your reason to buy, your reason to sell, it has to be very simple, and you can't be guessing. You need to say, when this happens, I do this. Very robotic. You could probably automate it as well, but that's the kind of mindset you need. You want it to be very simple that you can explain it to a 5-year-old. Look, something's always moving. So you had the lost decade in the 2000s, but you had crazy moves in gold and some commodities, right? That's a really good example. There's always something moving. Crypto, equities, commodities, currencies, doesn't matter. There's always something moving. So if you can create a process, especially it doesn't have to be day trading, right? Like we're busy people. It could be a daily chart, it could be a weekly chart. You can do this and create a process which fits around your life where you can catch these big moves in all asset classes on the weekly chart. A new headline's always out, right? And this is a bit different related to the news, but most of them don't matter. I think a really good frame to have is when you see a crazy headline on the news, a week later people don't care about it. And I know this is a really bad example, but typically when somebody passes away and dies, unless obviously they're really close to you, we don't remember them in 3 generations' time, as they say, right? Like no one's going to remember you. And I think the news is like a proper micro version of that. You could say 3 weeks' time, no one's going to care about the headline. Even at school, remember when something, crazy would happen within your friendship group or whatever. No one cares about it within a week. People move on very quickly. And, if you are always trying to chase headlines and chase stuff without a process, you're going to really struggle. So stay on top of everything. On the daily is not realistic, with a full-time job. Your time's limited, your attention's limited. So a weekly chart is a great way of creating a process. Every weekend for 2 hours, you just check these things. And that's what I'm going to be trying to do. And that's what I think most people should be trying to do. If we've got busy lives, we can't keep up with headlines. There's something always moving. How can I create a watch list that I can check week in, week out, and just consistently do that time and time again? I've got my rules. I enter when this happens. I sell when this happens, whatever it may be. Just a weekly process is all you need to outperform over the next 5 years. Basically, that's what you need to do. Not chasing headlines, not chasing daily crazy stuff. Just a weekly process that you can do week in, week out, and that you'll get really good results there. And look, your weekly process could be dollar cost averaging into the stock market or like the global stock market. And that's absolutely fine. That could be part of your weekly process. It doesn't have to be putting on these mad investments. It could be, I check my portfolio once a week, whatever it may be, and I will place orders to dollar cost average into the global stock market. That's another example you could do. So look, valuation data is extreme now, so it's really hard to, kind of see into the future, like what to do. So for me, I'm going to have a process to watch multiple asset classes on a weekly basis. Yes, I do stuff on the daily as well, but I'm really looking at, okay, cool, how can I take positions and stuff on a weekly basis to stay on top of a lot of things and watch a lot of things and not get married to a bias. The investors who underperform over the next 5 years will be too married to a direction. They'll think, I don't know, death of the US, but the US could be in a great accumulation zone to go higher. Or they could think the dollar's doomed, it's all to do with gold, and they could, enter, their feelings and opinions. And, when you're trying to do that, you're going to really struggle. And yeah, so you got to, in short, have a weekly process. Things are extreme. Watch multiple things on a weekly thing. Fits around your life. If you want to find out how I do things on a weekly basis, please do check out my newsletter. I think it will really help to find out how I'm structuring things on a weekly basis if you do want to outperform the market over the next 5 years. And yeah, thank you for watching, and I'll see you in the next one.